Welcome to this video on the implementation of the fixed units technique. To apply the fixed unit position sizing technique, we will calculate the number of units of our first trade. Then, we will continue buying the same amount over the whole backtest no matter what's the cost of the underlying. As we have mentioned before, fixed unit is not a position sizing technique per se. It's just a very easy methodology to calculate the size of trades. The first trade we do is on the 4th of January 2005. The price of SPY at that moment is $118.74, so we can buy 84 units of that ETF. The number of units we buy now are fixed till the end of the backtest. Every trade, we will buy 84 units of the SPY ETF. But how does our strategy perform after the fixed unit position sizing is applied? The strategy performance and the drawdown are a little less. The return to maximum drawdown ratio is higher than the benchmark strategy. However, the higher return to risk ratio is completely dependent on luck. That is because the leverage ratio for fixed units technique is strongly dependent on the price of SPY ETF. Ever since the 2008 crisis, the leverage goes down after the SPY enters a bear market. The leverage then stays low for a long period of time. As we trade the constant number of shares during the whole backtest, we do not have any power over the leverage ratio. It can be lower or higher, we do not manage it at all. The second picture illustrates what portion of money is used for trading. A large portion of money stayed idle for a long period of time, and we had no control over it. As you can see, the fixed unit technique is a simple approach to position sizing, but it is not safe at all.